Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes. The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries.
My name is Warren Esty, and I lead the investment bank for BMO Capital Markets. After a U.S. Inauguration Day announcement, and then Liberation Day, and multiple announcements between them, I'm going to venture to say every single person has been trying to assess the potential impact of scenarios on a daily, hourly basis. Just trying to make sense of the picture in totality. And so we are really pleased today to be able to host this speaker who is going to shed as much light as possible on the topic. Ernie Tedeschi is one of the foremost tariff authorities in the United States. Ernie is a director of economics at the Budget Lab at Yale University. And until March 2024, Ernie was a chief economist at the White House Council of Economic Advisors. Prior to CEA, he was a managing director and head of fiscal analysis at Evercore, which is a boutique advisory firm. Ernie was also previously an economist at the U.S. Department of Treasury. He completed his undergraduate studies at Stanford and his graduate studies at Berkeley. Michael Cipoletti, who leads our food, consumer, and retail practice on a global basis, is going to moderate a fireside chat after Ernie gives us a few opening remarks. Ernie, welcome and thank you.
Thank you for that very kind introduction. Thank you for having me. So all of the analysis that I'm going to go over today is public on the Budget Lab website, which you can see at budgetlab.yale.edu. It is a public good for you all to enjoy. I just thought I would go over where we are today, since it seems to change minute by minute, hour by hour. I can't guarantee you that my presentation is going to be valid by the time I'm done. So with that caveat in mind, before I even get into tariffs, I just want to set up the context for U.S. trade before we get into it. So you hear a lot about tariff action, particularly against China, Mexico, and Canada. China, Canada, and Mexico make up 40% of U.S. imports and are the destinations of 40% of U.S. exports. So when we're talking about specific tariff actions against those countries, we are talking about a plurality of U.S. trade worldwide just by focusing on those three. So in broad strokes, where we are at is we are at a 10% universal tariff on all countries except for China, Canada, Mexico, and the UK. We have special 25% North American rates on Canada and Mexico, with an exception for USMCA exempted trade. And we can talk a little bit more about this later, but basically, if trade follows rule of origin rules under USMCA, it is exempt from that 25%. There's also a special lower 10% rate on Canadian potash and energy. There are exemptions from those 10% universal rates on certain commodities, things like steel and aluminum and autos. That's not because all of those commodities are going to be carved out forever. It's because the administration either has already, in the case of steel and aluminum, or is planning to levy special separate commodity tariffs on all of those commodities. And we expect all of those commodity tariffs to be around 25% eventually. There was, as I'm sure many of you know, a special 125% reciprocal tariff on China that was just reduced on Monday to 10%. So with the 20% original universal tariff on fentanyl against China, plus this 10% reciprocal tariff on China, we're now at a combined rate of 30%. And then there was also the US-UK trade deal that kept the reciprocal rate at 10%, but created an exemption for UK autos and also created an exemption for UK steel and aluminum imports as well. So that's a lot of different tariff rates on a lot of different countries. So what's the bottom line? How do you make heads or tails of this? What I like to do is I like to calculate something called the average effective tariff rate. That's just a fancy word that means what is the average rate across all imports in the United States. Let's say that you had $100 of imports, there were no tariffs on the first $90, and then on the last $10 you had a 50% tariff. The average effective tariff rate on all $100 would be 5%. That's the weighted average on everything. That's all that's happening behind the scenes here. So because I'm a sucker for US history, I had to take this all the way back to Alexander Hamilton's time. I think the main takeaway, though, clearly, is that tariffs used to be much, much higher in American history than they are today. That's because until the 16th Amendment in 1913 that formalized the legalization of the income tax, tariffs were the main source of revenue for the federal government. We legalized the income tax, or formally legalized it in 1913, and then the federal government began a shift. They raised income taxes, they lowered tariffs. Tariffs had their last hurrah in the 1920s, and most infamously in 1930 with the Smoot-Hawley tariff. And then up until this year, it's basically been no looking back. Tariffs have been falling since the early 1930s. When you go all the way back to 2016, the average effective tariff rate before the first Trump administration was 1.5%. Now, people ask me, they were like, didn't we already go through a trade war back during Trump's first term? And the answer is yes. But over the course of 2017 and 2018, the average effective tariff rate only went up 1 percentage point, from 1.5% to 2.5%. As we'll talk about in a second, given everything that's been done in 2015 so far, including the new lower rates on China, so we're not talking about the 145%, we're talking about the 30% on China now. That would be the equivalent of raising the average effective tariff rate by 15 percentage points, going from 2.5 to nearly 18%. That would be the highest since 1934, since those days of Smoot-Hawley. Even after substitution, so after businesses, consumers make those hard choices and start substituting away from high tariff Chinese products, the average effective tariff rate would be more like 16% after all of that substitution, still the highest since 1937. I want to emphasize that even after all of that good news that caused the market to rally, we are talking about historically high tariff rates in the United States that are the highest in a century and are consistent with rates under Smoot-Hawley. Really briefly, this is what has actually happened so far. So I mentioned that, when we do the calculation that we're expecting a 18% average effective tariff rate. Well, when we look at actual government revenue data through April, we don't have day-to-day revenue data in May yet. What happened in April was an effective tariff rate of 4.5% so far. So government did bring in more tariff revenue, but not nearly enough to basically have tariffs be at full force. So one of the reasons I think why the CPI data that we got the other day was so positive in a slow, cool way, was because tariffs were clearly not biting at full force. We were expecting, a 18% average effective tariff rate. We were at 4.5%. So we have a long way to go before tariffs are fully phased in the United States. A Harvard study that looks at data from large American online retailers, one of which is Amazon, and basically pulls down data and divides data by the origin of different goods. And what it shows you is that actually Canada and Mexico origin goods that are sold online right now are not rising in price very much. Chinese origin goods are rising in price day by day, and they're already up 2% from where they were before the initial tariff announcement. Not all of that increase is incorporated into things like CPI. CPI was a monthly average for April. This is 2% increase in prices through where we are now in May. So, I would expect that the price effect of tariffs still has a long way to go to be incorporated into the data. Okay, So one of the things that we do at the Budget Lab is we model the economic effect of tariffs pre-substitution. And again, pre-substitution means before consumers start substituting to other things. We would project that the full price level effect of these tariffs would be in the order of 1.7% to the price level. Now, if you're like me, for a lot of you, that doesn't sound like a whole lot, 1.7%. But remember, a normal years of inflation in the United States, the Fed's target is 2%. So if we're talking about 1.7%, we're talking about almost an entire year's extra worth of inflation on top of the inflation we would have gotten already as a result of these tariffs. To translate that into the normal household, that's the equivalent of around $2,800 less in purchasing power per year in 2024 dollars each and every year. Now, as you might expect, not all households are different. And I think that this is a key thing to keep in mind as you're thinking about the consumer outlook and different companies. So tariffs are a regressive tax, especially in the short run. That's just a fancy word that means that they pinch households at the bottom more than the top. That's for several reasons. One, because households at the bottom spend a greater share of their income in general than households at the top. Second is because they spend a greater share of their budget on imports than households at the top. So they are particularly sensitive to tariffs. What we show is that as a percent of disposable income, households at the bottom are hit 2.5 times more than households at the top are by these tariffs. The effect ranges from $1,300 per household per year in 2024 dollars at the bottom to around $6,000 per household per year at the top. In terms of GDP, so we run tariffs through our GDP model, both short-term and long-term. We think that the effect of these tariff rates on 2025 would be to shave roughly 70 bips off of real GDP growth in 2025. That's the equivalent of $200 billion less in economic activity this year. What we find too is that even in the long run, the United States economy is persistently smaller because tariffs have an effect on long-run productivity. So the American economy is roughly 40 bips in level terms smaller 5 to 10 years out and in perpetuity. In 2024 dollars, that would be like the American economy being $100 billion smaller each year, every year, as a result of these tariffs. When you open up the hood of that number, it gets even more interesting. It's not that there are no winners from tariffs. We actually find in our long-run modeling that manufacturing output does expand under these tariffs. Manufacturing GDP in the long run in the United States expands by 1.5%. That is meaningful. However, it more than crowds out the rest of the economy. Construction output falls by 3%. Mining output and agricultural output fall each by 1%, such that net, when you combine it all together, the long-run economy in the United States is smaller by that 0.4% that I said earlier. So in employment terms, that would be like saying we have 280,000 jobs fewer in the United States in the long run. So we create about 100,000 manufacturing jobs, but we destroy about 300,000 construction jobs in the process. There is huge variation in which countries benefit and are damaged by U.S. tariffs. So China in the long run sees its GDP fall by 0.3% in the long run, almost as much as the United States. But it's Canada that really sees the worst of it. Its GDP is smaller by 2.3% in the long run. And that's a function of, number one, how symbiotic the relationship is between Canada and the United States. But number two, the fact that Canada has retaliated much more against the United States because we incorporate retaliation in our modeling versus the fact that Mexico hasn't retaliated at all against the United States. And retaliation exacerbates the economic damage of tariffs, interestingly enough. Not all countries are losers. The UK in particular, in our modeling, has consistently seen a bit of a GDP increase in the long run, even before the US-UK trade deal. And the US-UK trade deal dialed up the positive effect slightly. That's because the UK is well positioned, we think, to receive some of the production that flees other countries. Also, they've always had the 10% reciprocal tariff rate. They never had a higher one, even under the April 2nd proposal. So even when tariffs were high against the UK, they were always on the low end of global tariffs that the Trump administration was imposing. And then finally, as you might imagine, below that 1.7% average price increase, there's just wide variation in terms of the products that it applies to.
Thanks, Ernie. That was certainly a bracing introduction. And thanks again. So let's start with just some more general education and historical context. I was going to ask you to talk about 1901, 1934, but now with what you said about the income tax, right? Let's just ISO in on 1934. Last time tariffs, effective tariffs were this high. What was going on preceding the tariff increases, and then how did the economy react in the few years subsequent to those tariffs hitting their peak?
So here's one of the interesting things, is if you opened up Greg Mankew's textbook, if that's what you had in college, you would learn that the first order economic effect of a tariff is twofold. One, it puts upward pressure on the dollar because Americans are now demanding less imports, which means implicitly they're demanding less foreign currency. And if there's no retaliation, then foreigners are demanding the same amount of American currency. So the relative value of the dollar should go up as a first order concern. And secondly, that it's going to, since it puts upward price pressure, a central bank with an inflation target now has a choice to make about how it reacts to that price pressure. Jay Powell has said that they're going to treat tariffs as a one-time price level increase, not an inflationary increase, and which is exactly the right thing to do, right? Their mandate is inflation, not price levels. So presumably the Fed policy should not change as a direct result of the price pressure that is applied from tariffs. What is interesting from the 1930 experience is there was a substantial increase in tariff rates just as the Great Depression was accelerating. And what happened a year later was not that there was an increase in the value of the dollar, but a substantial decrease in the value of the dollar. And not that there was an increase in interest rates. The Fed was very different back in the 1930s, but it still did have some amount of active monetary policy. Interest rates were substantially lower as a result of that. Now, you might say, well, yeah, the Great Depression was accelerating. So of course, on the other end of that, everything was weaker. And those are exactly the results that we would expect. But I would tell you that just proves that reality is often messier than the textbooks. And I would point to exactly where we are with the dollar today. So in our modeling, for example, we made a choice early on to assume that there would be upward pressure on the dollar as a result of tariffs, because again, that is a standard conventional assumption in all economic textbooks. And lo and behold, the dollar is now weaker than it was on election day from last year. Now, that doesn't mean that the economics is wrong. It doesn't mean that tariffs don't put upward pressure on the dollar, but it does mean that investors look at the totality of what's going on around the world, and they see tariffs, but they also see the weakness in the U.S. outlook, and the second dominates the former. And that's probably what's going on here.
Gotcha. And we'll talk again about whether or not there are any historical parallels to countries tariffing themselves to prosperity or full employment. That we'll get into that a little bit later. So one more orienting question: 17% effective tariffs, but only price increases generally of 2-3%. For those of us that haven't really gotten down to detail, how do you go from plus 17 to plus 2 or 3? What's happening along that chain?
Yeah, it's a great question. So you often hear as a sort of model, people talking about a tariff as a consumption tax. And that's fine for explaining to normal everyday people how to think about how a tariff flows through the prices. But a tariff is not really a consumption tax. It's not like a sales tax. It's not like a VAT. It's a tax on imports. So first of all, imports are only a small share of total consumption. It's about a third of goods consumption. Imports are about 15%, I think, of overall consumption when you include services as well. So we're already talking about a narrower consumption base, right, than full consumption. And of course, tariffs don't just apply to consumption, however, they also apply to business inputs and intermediate inputs, things that a consumption tax decidedly does not apply to. So it's a very different set of mechanisms for tariffs to flow through to prices. So at the end of the day, that 17% average effective tariff rate, how it flows through the price be a function of several things. One, where we get our imports from. Two, how consumers and businesses substitute. So for example, when we go from that, it's actually 18% pre-substitution to 16% post-substitution, one of the things our model is telling us is consumers and businesses look at the 30% tariff on Chinese imports and bulk. And basically, and more than half of them say, we're going to try to find substitutes wherever we can. And the share of China imports in the United States goes from 14% to 6%. Back when the tariff was 145% on China, as you can imagine, trade collapsed even more in our model. It went from 14% to something like 2% of all imports. So that affects the final tariff calculation. And look, like I was saying before, we are not saying that there is no reshoring or no domestic substitution. That happens too. Something to keep in mind, though, is that there is an amount of domestic price increases as well. We saw this happen in 2018 with the China trade war back then. So for example, with the tariffs that we put on washing machines, on Chinese washing machines back in 2018, Maytag and Whirlpool, American brands that didn't have a substantial amount of Chinese parts in them, raised their prices by almost as much as the Chinese tariffs. Why did they do that? Well, it's pretty clear why, because their main competitor now had an unavoidable cost increase. And so, naturally, what would you expect them to do? They raise their prices. I call that an opportunistic price increase, and I don't mean that pejoratively. It's, exactly what you would expect a business to do. And if you had a tariff advocate up here from the administration or elsewhere, they would tell you that that's a feature, not a bug of tariffs, right? Like to give American businesses the room to be able to raise their prices and increase their margin. That's pure margin, right? Like they're not increasing their productivity. That's just purely on the top. The consequence of that, though, is that now the pass-through of the tariff to consumers and other businesses is potentially even more than 100%, right? As a result of that, because now you have companies and brands that are untouched by the tariffs possibly raising as a result of that.
So let's pivot. We've got two bilateral, a mini bilateral, and then a large bilateral with China. What do you make of them? Not just the financial impact on the U.S., but if you could get out your policy crystal ball, yeah. Are there any threads to weave together?
So let's talk about the US-UK deal first, because that's much easier to talk about. That's an insignificant deal. The one thing that it signals is that the UK is an ally, and they are a country with which we have a trade surplus, and yet we still insisted on keeping the 10% universal tariff on them. So the most valuable insight you can get from that deal is that it tells you where the administration is in their thinking. The 10% universal tariff is not going away. Some of the other commodity tariffs might go away. They eliminated the steel and aluminum tariff, and they reduced the auto tariff on the first 100,000 UK car imports from 25% to 10%. So they seem to be much more flexible on those tariffs, but it seems like the 10% tariff is staying. The China deal is both more and less significant than that in a funny way. It's less significant in the sense that there really isn't a deal, right? There's a deal to talk more about a deal, and they've given themselves 90 days. But look, that's the way diplomacy and trade negotiations go. It's, one thing to glean from that is that China is taking a very different approach from Canada, Mexico, and the UK in the discussions with the United States. So they are not looking for low-hanging fruit, quick win newsmaking deals with the United States. China seems to be very much interested in following the contours of conventional diplomacy and established parameters for coming to trade deals. And that takes a lot of time. And it's dry, boring, it involves a lot of different mechanisms, but hopefully in the long run is more stable when they actually do come to a deal. So that's one signal to take away from that. The other signal I take away from it is I was frankly surprised that the US went down to 30% with China. So look, as I've told others, I'm a reasonably smart person, but I don't have a PhD in Donald Trump. I have no idea, don't ask me where things are going there. But like in the back, what I've learned, I would say that like to the extent I've learned anything over the last year, it's President Trump has often verbalized what the end goal is in the back of his mind. And I would note that during the campaign, President Trump proposed a 10% universal tariff with a 60% tariff on China. And I'll be frank, a week ago in the back of my mind, I thought, okay, so that's where we're heading. That's the equilibrium here, is we're going to go from the 125% to 60%, and they just want some sort of rough 10% universal tariff. Well, now we're at 30% on China, which really widens the Overton window about what's possible. So there's good and bad to that. The good side, obviously, is that it opens up the possibility that we're much lower than 60% on China. On the other hand, now I would argue the uncertainty is even worse, right? Because if you as a business are thinking about medium to long run decisions, and by medium run, I mean even the holidays, and you're wondering, when do I pull the trigger on making those orders to China? Maybe you thought that like monotonically tariffs could never get better, right? And you were relatively confident that like, all right, if I place my order now, then it's more likely than not that I'm not going to get burned by not waiting later on. Now that's clearly not the case. You might be leaving real money on the table by not waiting the 90 days and seeing where they end up on a deal, because the deal might be 30%, it might be even lower than 30%. That really puts businesses, especially small businesses, in a bind. But just to add to the complication, if all businesses start pulling the trigger on orders from China, think about the ports right now. There are no ships in ports like Seattle, or very few, and ports like Long Beach are severely underutilized. If everybody tries to cram in their orders in the next 90 days, it's going to be like the pandemic again, right? And you're going to have ships lined up outside of ports. And remember that tariffs are not levied until the container comes off the ship. So if ships are delayed and they get late, we might potentially have a situation where orders that are placed well within the 90 days end up getting in outside of the 90-day period. And then there's a question about what tariff rate applies to them.
Uncertainty on top of uncertainty.
Yep.
One more question about bilaterals, and it's an unfair question to you and your team, given how quickly you changed the slides after the China news. But I'm just, as a layperson who's just reading about this, watching some stuff on the weekends, I wonder about the overall GDP impact. How does Main Street feel if all of the tariffs that we have right now basically come back to that 10% level? Have you thought about the implications of what if there just was a universal 10% tariff on all of our trading partners?
Oh, so a 10% universal tariff, I think, would shave in our modeling 20 basis points off of GDP growth, and it would have, definitely a small, I think 40 to 50 basis point upward pressure increase on the price level in the short run. Like, those are meaningful, but 20 bips to GDP is now almost indistinguishable from noise, right? Like, that is just a normal annual headwind among other headwinds that we're getting. Now, we expect other policy headwinds this year that are currently unknowable. Even when we were projecting the 145% tariff on China, and we showed a GDP impact of 1.1 percentage points, I was making the argument like, look, if you were projecting 2% GDP growth in the US this year, that's, you've shaved GDP growth in half. That's meaningful. That's significant. That's not necessarily recessionary, right? Now that we're down to 70 bips, it's even less clearly recessionary. And if we get down to 20 bips off of GDP, I think we're safely out of, the recessionary zone. Emphasizing, and let me add that, like, even talking about recession, I think, is not a very useful mode of analysis for this type of thinking, because recessionary is a binary state. You're either in it or you're not in it. I think for you all, it's just much more useful to think about the drag on GDP, consumer spending, that sort of thing, try to quantify it in some way. So not that 20 bips is nothing, that's about $60 billion off of economic activity. But that, now we're in the realm of things that I think are much more manageable for businesses and consumers.
Let's talk about key non-U.S. stakeholders. Yeah. Is there a way, given your negative 2.3% GDP impact on Canada, how much closer is Canada to a recession because of this?
From an economic standpoint, the interesting contrast between Canada and Mexico is that there's been retaliation from Canada, virtually none from Mexico. And what I tell people is, look, the same sort of economic forces that cause us to place tariffs on other countries are present in other countries too. So we should not be surprised when there is retaliation in other countries. The downside is that exacerbates the negative economic effects. And so I think that if Canada in the end comes to a deal with the United States where we mutually sort of bring down our tariff rates, and obviously from Canada's perspective, they would want to see, real decreases in American tariffs, that negative 2.3% would be mitigated significantly as a result of that, and would probably be much, much closer to Mexican levels. I think the other thing driving that too, by the way, the difference between Canada and Mexico is that there's a lot more USMCA exempt trade coming in from Mexico. So roughly half of all trade coming in from Mexico, imports coming in from Mexico, are exempt from tariffs under USMCA because they meet the rules of origin requirements, whereas it's only about a third in Canada right now. And that just has to do with the composition of the trade that we have with them.
Pivot to China.
Yep. So I think China has played it, exactly as a country of their magnitude and stature would be expected to play it, which is that they're, unlike even Canada, Canada's retaliation against us has not been nearly tit for tat. China's retaliation against us has been much more proportional to the tariffs that we've put on them, which I think strategically makes sense. It's painful for them, particularly when they tax things like soy on their citizens. So that could not have been an easy choice for them to make. But I think that was, from a sort of economic game theory standpoint, that was probably the right thing for them to do. I think it got our administration to the table, because I think, frankly, at the end of the day, what was happening with markets spooked this administration. And I want to emphasize, I think that that's a positive development. I think it shows that this administration listens to markets, will change their plans when they hear feedback from markets, and they are not completely rigid in a certain number and in certain ways. And it's clear that tariffs are going to be higher under this administration, no matter what, than they were beforehand. But I think it's a positive development that they are willing to adjust their policies on the fly, depending on feedback from markets. So that's a good thing. And I think that was helped along by the response from China. And I think that the fact that China is, like I was saying before, not looking for easily misinterpreted, quick win, low-hanging fruit announcements with the United States, but is looking for a formal WTO type process that will drag on for a while, and that in the short run may heighten the uncertainty, but will ultimately lead, hopefully, to a more durable solution. I think that that's the right way to engage with this administration.
Unfortunately, we're out of time. We'll have to leave it there. Ernie, thank you very much for such an interesting conversation.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.